All right, so I want to show you what it would look like side by side if you were to compare depositing $200 a month, starting with $0 over the course of the next 30 years. So I'm going to show you what it's like if you were to have put this $200 a month into a savings account, which the average savings account yields you about 0.6%. That's right, 0.6, not 1.6 and not 6%, but 0.6. So not even one whole point. The average rate of inflation is around 3%. So we're going to see how much money you should need in order to sustain the actual amount that you deposit. And then what it would be like if you were to invest $200 a month into the stock market with an average return rate of about 10%, which is very doable. So if you go down here, and let me say this first. This isn't my chart. Found this online. These numbers down here are off. Right after 19, they should go to 20, and this should go up to 30. So this is a 30-year horizon. So and there are three different bars on here. So the dark blue is a savings account at 0.6%. The green line is the rate of inflation at 3%. And then the light blue is 10%, which is going to be investing in the stock market. So let's look at year 5. You have in your savings account $12,184. Well, the rate of inflation is $12,948. So you can already see your money is worth less 5 years later. It's worth less the first year. And at the end of 5 years, if you invested in the stock market, you will have 15,000. Let me hover back over this, 15,434. So let's jump to 10 years. 10 years, if you invest in a savings account, you'll have 24,739. The rate of inflation, your money, you would need 27,958 to maintain what you initially put in there. So you're still losing money because inflation is beating your savings account. If you're investing in the stock market, however, you would have, let me get back over here, 40,291. So let's jump ahead to, and I'm going to leave inflation out for these next few examples. Year 15, if you invested in savings alone, you would have $37,674. If you invested in the stock market, you have $80,000. And this is the same $200. Saying you're not putting in any more money. You're still putting in the same $200. One instance, 200 is going into a savings account, which is only giving you 37. And one is going into the stock market, which is giving you about 80. So let's jump to year 20, which is actually this one. So in your savings account, you will have about $51,000. And if you invested in the market, you will have $144,000, almost $145,000. That's significant. So over here, year 26 on this chart, which is actually 25. If you invested in the savings account, you have about $64,000 and some change. If you invested in the stock market, you have almost $250,000. So let's look at the end of this. And this is why the longer you invest in the stock market, the better. So if you notice, as time goes on, these numbers keep compounding. They keep adding. And this is where money in the market starts to really take off. So in year 30, if you're still, this is the same $200 a month. Putting the $200 into a savings account, you only have $78,000, almost $79,000. If you invest in the stock market, however, at the end of year 30, you will have $415,000, almost $460,000. That's ridiculous. Savings account is like $78,000. In the stock market, $415,000. Now, your $78,000, you actually need $116,000 to actually maintain what you actually initially put in. So your money in your savings account actually loses value every single year. This is why you need to get invested in the stock market. If you want to learn more about how to get started, where to get started, click the link in the description and I'll show you where you can get the ball rolling. It's not too late. Doesn't matter if you're 35 or 55. It's never too late to get started. You can always increase the amount that you deposit. And again, this is only based on $200 a month. So you can invest $500, $1,000, $2,000, $5,000, whatever your budget allows. All right. See you guys in the next video.